Okay, let's talk about 2026. If you're looking at the market right now and it just feels, well, completely chaotic and confusing, trust me, you are not alone. So today, we're going to try to cut through some of that noise and break down three really different ways this whole thing could play out.
This phrase just perfectly captures the last year, doesn't it? I mean, you had the bears on one side who were absolutely convinced a recession was right around the corner. And then on the other side, you had the bulls just snapping up AI stocks like there was no tomorrow. You could practically feel the tension in the air. And all that tension really boils down to this one question for 2026. Is the economy finally going to hit a wall? That's our hard landing. Or will it just kind of glide down gently for a soft landing? Or maybe, just maybe, it'll somehow defy gravity and just keep on flying. This is the big question, so let's dig into the three most likely answers.
All right, first up, the bear case. Let's start with the pessimistic view. Tackle the elephant in the room and get all the fears out on the table right away. Well, from the pessimist point of view, there are some pretty serious cracks starting to show in the foundation of this whole market rally. So, what are they actually pointing to? What are the specific things that could send us into a downturn? The number one concern is, without a doubt, valuations. Things just look really, really expensive. Right now, the S&P 500 is trading at about 31 times its earnings. To put that in simple terms, it means investors are willing to pay $31 for every single dollar of profit a company makes. That is a very steep price. And here's where it gets kind of scary. You have to compare that 31 to the long-term average, which is around 16. Yeah, we are trading at nearly double the historical norm. If things just go back to normal, what they call mean reversion, the entire market could take a pretty big hit. And this is especially true when you look at the AI craze. You've got companies like NVIDIA trading at 47 times earnings, and some are way higher than that. It's pretty clear that this isn't about what these companies are earning today. Investors are basically placing huge bets on a future that's, well, pretty uncertain. It's not investing, it's like you're pre-ordering hope. The second big red flag for the bears is concentration. This isn't a case of a rising tide lifts all boats. Nope. The entire market is basically being dragged upward by just a small handful of mega-cap tech stocks. The Magnificent Seven, as they're called, now make up more than a third of the entire S&P 500. Think about that. And this is the engine that's pouring gasoline on that fire. It's a feedback loop. See, as the big tech stocks get bigger, they naturally become a larger slice of index funds. So when you invest your money into an S&P 500 fund, more of it automatically goes into those same stocks, which pushes their prices even higher, which makes them an even bigger slice of the index. You see where this is going? It's a beautiful cycle, until it suddenly isn't. But here's the really tricky part for the bears. Even if you're 100% right about valuations and concentration and all of it, timing the market is next to impossible. And as Keynes famously said, the market can stay irrational a lot longer than you can stay solvent. Being right too early is pretty much the same as just being wrong. And that's actually the perfect transition to our next scenario. Okay, so let's flip the script. Let's look at the bull case. What are the powerful forces that could keep this market rally going, even with all those risks we just talked about? This is the question that every bull is asking right now. What if the market just doesn't care about historical averages anymore? What if the irrationality just keeps on going, and this party has a lot more room to run? The whole optimistic case really boils down to two huge tailwinds pushing the market forward. On one side, you have the Fed's monetary policy, and on the other, you have the government's fiscal policy. Let's quickly break down both of these. So first up, the Fed. The expectation is that after a series of cuts in 2025, rates are going to keep coming down. And lower rates mean it's cheaper for businesses to borrow money, and it makes investors feel a lot more comfortable paying those high prices for stocks we talked about. When money gets cheaper, risky assets like stocks tend to do really well. The other half of this equation is just massive government spending. The US is running a deficit of over $1 trillion a year. Now, that's a huge long-term problem, for sure, but in the short term, it's like a powerful shot of adrenaline for the economy. It pumps money directly into the system, which props up spending and helps corporate profits. Okay, so this is where it gets really interesting. You have these huge, powerful forces for the bulls and the bears pushing against each other. And when that happens, the outcome is almost never a clean win for one side. That brings us to a third scenario, the one that honestly, it feels like almost nobody is ready for. So just to recap, we've got our two camps, right?
The optimists are looking at the Fed and government spending and are getting ready for another big rally. And the pessimists, they are looking at valuations and fundamentals and are bracing for a major correction.
But what if neither of them gets what they want? What if instead of a huge melt-up or a painful crash, we end up with something way, way more frustrating? I'm talking about a sideways market, a long, choppy, painful period where the market just goes nowhere. It grinds up, it grinds down, but there's no real direction. It's not a crash, but it is definitely not a rally either. It's just stuck.
And honestly, these kinds of markets can be the absolute hardest to invest in. Every little rally sucks you in, only to fizzle out. Every dip feels like the beginning of the big one, but then it just recovers. You're constantly whipsawed by headlines. And in this kind of gray area, it's impatience that really becomes the biggest enemy of your portfolio. So we've laid out the case for a cool down, the case for another rally, and this really uncomfortable gray area in between. Let's try to wrap this all up with a clear takeaway. Here's the bottom line. Nobody, and I mean nobody, has a crystal ball. The point of this isn't to give you a prediction. It's to give you a mental map to navigate the uncertainty ahead. If you understand the arguments for all three scenarios, you can be so much better prepared for whatever 2026 actually decides to throw at us. And now that we've laid it all out, I want to leave you with this question. After hearing all the arguments, the bull case, the bear case, and the sideways grind, where do you land? Which path seems the most likely to you? Are you a bear, a bull, or are you preparing for that long, frustrating ride in the middle? Something to think about.